In San Francisco, and this is Bloomberg Technology. Coming up in the next hour, doom and gloom. Stocks slide as recession warnings pile up. For the battered global economy, we will bring you the latest in the markets with details about how the tech sector made out. Plus, lots of work ahead for WeWork now that the office space company has filed for its IPO. Can it find a path to profitability? And the chair of the U.S. Federal Trade Commission says he will break up big tech companies if need be, but get ready for things to get messy if he tries to. First, our top story, U.S. stocks suffering another deep sell-off and treasuries surging as mounting signs of a global economic slowdown stoked fears of a recession. The S&P 500 sank almost 3% with big tech driving the losses. Names like Apple, Microsoft, Amazon all closing deep into the red. Volatility has gripped the index since President Trump rekindled the trade war with China at the start of August. The S&P 500 has swung at least 1% intraday for 11 straight sessions and is now down 6% from a July record. To discuss, we're joined by our Bloomberg cross-asset reporter, Sarah Ponczek in New York. So, Sarah, first of all, a lot of bond buying today. What does that mean for tech?
Absolutely a lot of bond buying. If you look at longer dated bond yields, the 30-year falling to a record low. At the same time, not just seeing a bond rally, but we also saw a yield curve inversion between the 2-year Treasury yield and the 10-year Treasury yield for the first time since 2007. Now, at the close, no, we were no longer in negative territory. We should mention that. However, that does stoke concerns. So what that means for tech going forward. So if you think about some of the most high beta areas of the market, tech is largely put into that group. Maybe not as much software, but when you think about semiconductor stocks, even the likes of Apple, because they are so intertwined with China as well, some of these areas are very well intertwined with the global economy. And the fact of the matter is, when you think about the message that we are seeing from the inverted yield curve, sure, some are saying that this time is different because you see flows from foreign money into bonds. Also, some say that the yield curve completely is artificially lower because of what central banks around the globe have been doing. But in the past, it's preceded a recession. And if you do believe, those who do believe that a recession could be in the offing, maybe 12, 18 months out, then that doesn't bode well for some of the big tech names.
Now, all day we've been talking about historically how, this sort of bond activity can be a sign of a recession. What does that mean for tech especially?
So typically when we do see these signs, you don't see a reaction right away. Well, you do see a reaction right away, but that doesn't mean that the stock market is completely peaking right away. But if you look at some of the fallout that we did see today, I'll point out that if you look at the Philadelphia Semiconductor Index, for example, we did see a pretty steep fall, falling into correction territory, actually now down 11% from the highs, plummeting through its 50-day, through its 100-day moving averages. That 200-day is still pretty far away. But what was interesting to me was the fact that if you look at software, if you look at hardware, those two areas actually fell even more than semiconductor stocks, which are typically the more volatile area. And you do have to take into account the gains that we saw yesterday in hardware stocks led by Apple, because yesterday we were dealing with the news that the tariffs were going to be delayed. Well, now we are getting the flip side of that, not so much about the tariffs. The tariffs are still delayed. But when you get a really strong rally in Apple and tech hardware, whenever you get a steep sell-off in the market, then you're going to see that come right back.
All right, let's talk a little bit about cryptocurrency, because a couple of weeks ago, even a week ago, we were talking about Bitcoin potentially being a safe haven. As the rest of the market was going down, Bitcoin was going up. But the last 3 days, Bitcoin has plunged. So is that not the case?
I don't know if that is absolutely the case. We have heard that statement made that you look at the likes of gold. Gold is clearly a safe haven. You saw gold higher today. You saw the Japanese yen higher today. Very strong gains. Some look at Bitcoin and say, oh, it's a similar story to gold. You can think of Bitcoin as a safe haven, but the fact of the matter is Bitcoin is extremely volatile. No one can debate that statement. So it's very difficult for people to actually look to Bitcoin as a true safe haven because of the volatility that you see from day to day, just seeing strong swings one day and then huge falls the next. So I don't know if you can go as far to say that Bitcoin is a true safe haven just yet.
All right, Bloomberg's cross-asset reporter Sarah Ponczek. Sarah, thank you so much for that update. We'll continue to hit on the markets throughout the show. Meantime, WeWork has officially filed for its IPO. The billion-dollar offering size likely just a placeholder, and that will change when the terms are set. WeWork is expected to raise actually closer to $3.5 billion. That would make it the year's second largest IPO behind Uber. WeWork revealed a loss of $690 million in the first 6 months of the year and almost $3 billion lost in the last 3 years. Joining us with all the details, our very own Ellen Hewitt, who has been covering WeWork to this point. So what were the surprises in the S1? Any?
Well, there were some things that we already knew. Anyone who's been following WeWork closely knows that they've been giving out select financial information quarterly for the last year or so. So we already knew that, for example, in 2018, WeWork lost close to $2 billion while making a revenue of around 1.8. But there were some surprises. I think we got more details about some of the loans and complicated financial structures that go on between the founder, Adam Neumann, he's also the CEO, and the company. We had gotten some knowledge about this before. You know, he has famously been a landlord in a few properties that WeWork has rented, but we got some new information about loans that the company had made him, the succession plan that would happen if he were no longer able to serve as the CEO, that kind of thing.
So our colleague Shira Ovide called it the office subleasing company on steroids with a complicated corporate structure. Now, on top of this, they're offering 3 classes of stock, one with 20 times voting power as another, which even takes a step further than what Mark Zuckerberg and the founders of Google have done, right?
Right. There's actually 3 classes, and 2 of them have 20 votes per share, and the one, Class A, has 1 vote per share, as you would expect. So, right, that's a great consolidation of power. It's all, or not all, but largely in the hands of Adam Neumann. He has a lot of voting control over the company, and that's kind of by design. People who support this structure think that Adam has the right vision, the boldness, and the leadership to take WeWork even farther than it has been. And obviously, for some other people, they're going to look at that and raise their eyebrows, thinking that might be too much.
Now, the other thing that's interesting is they laid out exactly how many of the buildings are fairly new. 30% of their locations are mature, as they say. 70% are 2 years or younger.
Yeah.
So the vast majority of their space is incredibly new.
And they've actually changed the definition of that metric of a mature location. It used to be 18 months. They've expanded it to 24 months. And even with that expansion, you're right, it's only 30% of their office locations have been open for more than 2 years. They look at that as pointing to
high growth.
High growth.
Now.
Right, exactly. Like, look how fast we're growing. But it's also interesting because a lot of the most stable unit economics that they like to highlight are focused only on mature locations. They say these are where we no longer have to rely that much on marketing to fill the buildings. But when you start to realize that's only 30% of their portfolio, it starts to raise some questions about how sustainable their growth is and how easy it would be for them to get to profitability if they stopped growing.
Right, and they say in their risk factors they may never be profitable, which is similar to what we heard with Uber and Lyft. How are investors feeling about this company? Are they excited?
I mean, I certainly see a lot of activity on Twitter on both sides. Some people think that the growth is really exciting, and other people can't wait for it to go public so that they can short it, right? I think it's just going to be a divisive stock. We're going to see that the price is going to be decided soon by the public markets, and I think a lot of people are looking to see whether it's going to meet that $47 billion private valuation.
So how quickly do we expect them to get to market? When does the roadshow launch and all that?
It could happen very soon. So sometime in the next few weeks, we expect and have reported that we expect a September IPO, and that's just around the corner.
All right, Bloomberg Tech's Ellen Hewitt, you will be covering it every step of the way. Thank you. Shares of Uber, meantime, fell to a record low Wednesday. The market value of the ride-hailer has fallen by more than a fourth since its IPO. Much of that has come in the week since the company reported its earnings. Uber missed revenue expectations and posted a $5.2 billion loss. All right, coming up, Huawei heads to the lobby. How the Chinese telecom giant is fighting for its U.S. survival by using an age-old tactic, Washington lobbyists. That's next. And if you like Bloomberg News, check us out on the radio, listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. All right, we have often covered how big U.S. tech companies are lobbying Washington with spending on their D.C. advocates going up. Now, even the embattled Chinese telecom giant Huawei is working the power of lobbyists in the U.S. Capitol. Huawei has hired the law firm Sidley Austin to lobby on trade and other national security issues as it fights for the right to do business in China. Joining us to discuss in Washington, we've got Bloomberg's Ben Brody, who covers tech and their lobbying efforts. And here in the studio, our global executive editor for technology, Tom Giles. So, Ben, what exactly is Huawei doing here, and why do they want Sidley Austin on board?
Well, they've hired Sidley Austin. They've also hired a group called Federal Advocates that has a lot of ties to the Trump administration and Republican leadership. And basically, as we understand it, what they want to do is lobby on those export controls that are stopping them from buying into the U.S. market right now. The lobbying disclosures are a little bit vague about it, but they do clearly say export controls in the case of Sidley Austin. That's the law firm that's also working with them in some other cases. And then we also have telecommunications issues that they're working with that other lobbyist. So it does seem like they're trying to break the back of that blocking.
And you write that they actually almost shut down their lobbying operations last year, and now a full 180, presumably because of the president putting them on a blacklist?
That's what it seems like. They had gone down to about 3 staffers here in downtown Washington, D.C., a little bit over by the White House from where I am sitting now. They had basically gotten rid of all their outside consultants, or they weren't having them do anything, or they weren't spending any money. Now they've hired, at least that we can see, 3 law firms to add lobbying onto their mandate as law firms, as well as this sort of Trump-connected firm, Federal Advocates, and Michael Esposito, who is an advisor to RNC Chairwoman Ronna McDaniel and is on a top fundraising committee for the Trump re-election campaign.
Now, meantime, Tom, the trade war, again, sort of escalating in fits and starts. The president now delaying tariffs on some goods until December. Those others will go into effect in September. You've got some interesting dynamics happening between President Trump and Beijing, given the Hong Kong protests. And all of this continuing to impact, tech companies continue to impact the supply chain. You've got the maker of HP laptops now saying they're moving their production out of China.
It just makes sense to look for an alternative to mainland China. What we've seen over the last several months is tech companies looking to move bits and pieces of their production, 5% here, 10% there. We'll kind of do it around the edges. The problem that a lot of tech companies are encountering right now with U.S.-China relations is no matter how this gets resolved, it shows you the vulnerability of and the risks of keeping all of your supply chain in mainland China at a time when the U.S. president can wreak havoc with U.S.-China trade relations by, threatening this trade war, imposing the sanctions, ratcheting them up, ratcheting them back. There's a game, what looks like a game happening here. If you're reliant on China, you can't be subject to the whims of one administration or the Chinese government on the other hand, whatever the case may be. Is this truly going to result in better trade relations between U.S. and China? Is this all a negotiating ploy heading toward the 2020 election? It's so really hard to tell. All that aside, if you're relying on China, you need an alternative. And I think that's what's happening here, is no matter how this gets resolved in the short term, longer term, U.S. companies are saying it really does make sense for us to look outside. And so we're seeing, with every day that passes, every week that passes, another U.S. company talking about or showing in one way or another, we're looking for an alternative. And so you're increasingly seeing the emergence of this alternative second supply chain.
Meantime, Ben, you've got the U.S. government leaning on allies to not rely on Huawei, to push Huawei out of its plans for 5G networks, as Huawei has become a sort of pawn in this U.S.-China trade war. Are those U.S. allies coming on board? Whose side are they on?
Yeah, I mean, I think that map that you have up there really tells the story. The U.S. has really struggled to convince allies that they need to make this move. We've heard reports that there is some movement potentially with India, that India might be willing to go up against China in that particular move. But when it comes to Europe, when it comes to the top allies, those countries that we share intelligence information with, it's really been a struggle. And it's not hard to see why. Huawei gear is cheap and reliable, and Huawei keeps coming out and saying, well, our gear has no more cybersecurity risk than anybody else's. There's always a possibility of backdoors. And for the most part, our allies, maybe in private conversations, are saying, yeah, we're a little bit worried about it. We're going to keep it out of the core of our networks. But they're saying, look, I just think you're kind of out of luck. You're going it alone here.
Tom?
There's a big question mark for a lot of our allies about just how much of a threat Huawei really is, and they're really confident. The one thing they're sure of is that Huawei equipment is seen as pretty darn reliable, pretty good, and pretty cheap. And what are the alternatives? And that's a question that is hanging over the deployment of 5G. And if
it seems like there are no alternatives of the same quality level, correct?
That's what we hear time and time again. You have people like Nokia, like Ericsson, who do provide some of the infrastructure, some of the equipment, but is it as reliable, is it as fast, and is it as cheap? And the answer seems to be no. And so there is this question mark about, we really kind of want to see more evidence that Huawei is going to create backdoors, and they're not seeing it so far.
Right. Is it a security risk is the question. Okay, Bloomberg's Tom Giles and Ben Brody, thank you. Of course, we'll continue to cover that Huawei story in and out. Coming up, the global alternative meat market is expected to reach over $6 billion by 2023. How new vegan brand Prime Roots plans to compete alongside popular companies like Beyond Meat and Impossible Foods. Next, this is Bloomberg. T-Mobile's proposed takeover of Sprint has now moved forward to a vote by the Federal Communications Commission. It is the last federal regulatory hurdle for the deal. Still, a group of states has challenged the deal in court. The suit says the T-Mobile Sprint tie-up will reduce competition and raise prices. Well, Beyond Meat has seen its shares hit in the last couple of days as concerns mount about global growth and the strength of the consumer. The stock still up, though, more than 550%. Since the company's IPO in May, it's helped move plant protein out of the periphery and onto supermarket shelves. The problem for Beyond Meat is come 2020, the meat alternative market is about to get more crowded. New vegan brand Prime Roots is planning to roll out its, quote, super protein meat and seafood substitutes next year. But unlike the existing plant-based options on the market, it is using fungi to create meatless products ranging from chicken tenders to lobster to salmon burgers. How is this possible? Let's ask. Joining us now, Prime Roots CEO and co-founder Kimberly Lay. She is also a Thiel fellow, that is Peter Thiel. So tell us about the technology and science behind these products.
Yeah. So at Prime Roots, we're really creating no compromises meat and seafood alternatives. And really how that's possible is we use a koji super protein. So what is koji? Koji is an 8,000-year-old Japanese superfood. And what we do is we grow the koji, so it's a whole food source of protein that has more protein than meat and micronutrients that you can't find in plants. It has the natural texture of meat, so we're able to replicate everything ranging from lobster to beef to everything in between. So
how do you replicate it?
So naturally, the texture of meat comes from the koji. So it grows in fibers that are analogous in size to the shape and size of animal muscle fiber.
So some of your products, chicken tenders, bacon, lobster, tuna chunks, crab cakes, dips, salmon burgers, protein bars, you're saying you can make all of that from the same kind of mushroom?
Yeah, so we have made all of that. So that's the exciting thing, because we're able to iterate and make products like no other meat alternative company in our space. And right now we're really focusing on building a community and a brand around our products to propel us and our diversity of products into the mainstream.
Now, you actually haven't launched any products yet, but you're actually asking consumers to vote on which you should launch in 2020 online. What's been the most popular?
So Bacon has by far been the most popular product.
Really? That's the one where I was like, they can make bacon?
But bacon though. So people love bacon, and a lot of people are vegetarian except for bacon. So I can see why bacon is definitely the most popular. But we have a lot of products that are ranking really high up in our voting right now. So for us, it's really important to listen to our consumer. And really, all of our products have been developed with the help of our community.
So what do you think sets you apart from Beyond Meat's Impossible Foods?
Yeah, so the space is growing really fast, but all of the plant-based alternatives like Impossible and Beyond are really taking an ultra-processed approach to making foods from plants. And what we're doing is we actually grow textures naturally. So our product is not ultra-processed. So that's a large concern for consumers in the space and people who are looking to buy these products. And we're really taking that to heart and making a product that's completely all natural, non-GMO, and is naturally made. So I started the company and I actually grew and made all of our products in my kitchen. So this is, far cry from lab grown. This is reality, and this is also wholesome food that everyone can get behind.
So what other applications do you see of, this kind of biotechnology in the future of food?
I see that, in food specifically, for our technology, really the options are endless. But we're really focusing on meat and seafood first because naturally the koji super protein we grow has that texture.
And you're planning to sell this directly to consumers?
Yes.
Rather than putting it on store shelves?
Yeah.
Why?
So I think another large problem currently with the industry is that there is really this tops-down way of thinking about the consumer, and for us we're really taking a bottoms-up approach. So everything from our product voting to how we're interacting with the consumer, we're really taking that to heart and changing the whole experience. So for us, we've had tasting dinners, we have many events where people can come interact with us and also try the products. So while we haven't sold products officially yet, we've been doing a lot to build community, and over 10,000 people have actually already tried our products.
All right, well, we'll be watching for that bacon to hit to hit your shelves next year. Prime Root CEO and co-founder Kimberly Lay, thank you so much for joining us. Coming up, breaking up big tech. The FTC chair says he's willing to do it. Under what circumstances? We will discuss. And we'll get back to the main story of the day, the global market sell-off, how tech is faring as recession fears mount. This is Bloomberg. This is Bloomberg Technology. I'm Emily Chang in San Francisco. Back to our top story. What the tariff delay giveth, the yield curve taketh away. The S&P, NASDAQ, and the Dow all ending Wednesday's trading down around 3% as mounting signs of a global economic slowdown stoked fears of an economic recession. To make matters worse, both the U.S. and UK yield curves inverted for the first time since the financial crisis. Here to tell us more, Bloomberg Tech's chief equity strategist, Gina Martin-Adams in New York. So, Gina, what are you reading into this and what it means for tech?
Yeah, so we've been in a correction in the S&P 500 since late July, and this is just more evidence that the correction persists. I mean, you don't have weak days like this in the midst of just a minor sell-off. We started talking about this last week when we had a 3% correction in the S&P 500 on Monday. We were down nearly 3% again today. These type of panic days usually happen in the midst of bigger corrections of 10% or more. What does it mean for tech is tech, unfortunately, is one of the highest beta sectors. It also is one of the sectors most exposed to global growth, most exposed to business investment, most exposed to China. As a result, the semiconductors and equipment names in tech are going to get damaged more in a sell-off. I think the software names are at risk as well, only because this is the place where everyone's hidden in tech. This has been the source of support, software and services. But as a result of the fact that they've continued to power higher, powering stocks higher this summer, they're also pretty high beta, so they tend to get thrown out with the bathwater when markets are sort of a sell now, think later mode, which is the mode that we're in now.
So what do you think's been a bigger driver of the tech sell-off? Trade fears or recession fears?
Good question. I think that up until the last couple of weeks, it was really more about trade. Especially over the last week, we started to see some pretty significant deterioration in economic data overseas, and then the yield curve And the significant meltdown in rates globally over the last couple of weeks would have suggested that this may be more about those trade concerns leading us into recession. So it started with trade, and it's becoming this ongoing drag. And trade, frankly, that's the real takeaway of trade, is this uncertainty with respect to trade is going to constrain business investment, keep activity from accelerating, and as a result, we may start to tip over into recession. And I think that's what the market is most fearful of right now.
All right. Well, we'll continue to follow the markets as they reopen in Asia. Bloomberg Intelligence's Gina Martin-Adams, thank you so much for joining us. Now to a story we continue to follow. Washington targeting big tech for antitrust violations. The chair of the U.S. Federal Trade Commission is weighing in. In an interview with Bloomberg, Joe Simon said his agency is ready to get down and dirty if necessary. If you have to do it, you do it. It's not ideal because it's very messy, but if you have to, you have to. Remember that the FTC is currently investigating Facebook, including its acquisitions in an antitrust probe that is just one of the big tech companies being targeted by the Trump administration. To discuss in Washington, Charlotte Slayman, Policy Counsel for Public Knowledge. Before that, she was part of the FTC's Anti-Competitive Practices Division. In New York, we've got Sally Hubbard, Director of Enforcement Policy at the Open Markets Institute. Before that, she was an Assistant Attorney General in the Antitrust Bureau of New York State. And here in the studio, we've got Sarah Fryer, who covers, of course, Facebook for us. Charlotte, I want to start with you. What do you read into Joe Simon's comments?
It's hard to read much into it. If you have to, you have to. That's almost a tautology. But I think maybe what he's talking about is that it can be difficult to force significant divestiture, something that we would call a breakup. And in order to get that type of remedy at court, you need to show that it's really necessary. So again, sort of a tautological comment, but I think maybe that's what he means there.
Sally, would you agree? I mean, there's certainly been a lot of question given that the FTC recently fined Facebook $5 billion for privacy violation, but critics said it wasn't, that fine didn't go far enough. Do you agree that he has what it takes, or the agency has what it takes to make that leap if they have to?
I think he was just really stating the fact that that is a remedy that every antitrust enforcer needs to consider. I wouldn't really expect it out of Joe Simons, given how he handled the Facebook consent decree violations and really just gave them a slap on the wrist. I know a $5 billion fine sounds like a lot, but it's really not going to change anything or protect the American people from privacy abuses. So I don't expect to see anything aggressive coming out of this administration. However, these cases and these investigations take a long time. So it may not be Joe Simons who's ultimately the one making the decision about what the proper remedy is, whether it should be broken up or a different type of conduct.
Meantime, Sarah, you've got a new piece out in Bloomberg Business Week that speaks to how Facebook has evolved under scrutiny from regulators after this fine, this penalty was levied by the FTC. And your assessment is Facebook's only getting stronger. How so?
If you think about it logically, the data is the most important part of Facebook's business model. That is what is at the bedrock of the $70 billion advertising business this year. And the FTC is basically telling Facebook, now it's very important that you don't share your most valuable asset with any third parties. And Facebook had already buttoned it up. They already don't want to share their data with third parties anymore. They understand that owning the network and owning a much bigger network and making that network bigger is the most important thing for the future of their business. So really what the FTC did is let the company continue on its current path and have an excuse to do things that are anti-competitive, like combine its messaging apps.
So, Charlotte, talk to us about, well, first of all, would you agree with Sarah's assessment there?
Yes, I think that's a major concern. Something that I was hoping that the FTC might do in this settlement would be have some requirements for interoperability with competitors. That is a form of data sharing, but it allows competition, so I think it's really important.
So, Sally, at what point do you think the FTC would say, okay, this is a company that needs to be broken up? Whether it's Facebook or Joe Simon specifically spoke to Amazon in particular and the issue around third-party sellers.
Yeah, so, it takes years of investigation before an enforcer is going to break up a company. In our history, when it's been done, it's taken time. I think, like I said, it may very well be after the 2020 election, and we could have even a different decision maker making the ultimate decision. And, the concerns that he voiced about Amazon, I think, are also very important, that it's not allowed to enforce basically rules that it said it wasn't going to do in terms of low pricing on its third-party sellers in a different way.
Charlotte, as somebody who worked at the FTC, how concerning is the Amazon issue in your mind?
Well, the FTC certainly wants to make sure that competition is happening fairly on the Amazon platform. So small retailers ought to be able to compete and not worry that Amazon is going to anti-competitively interfere with them. So I think that's the kind of thing that the FTC is going to be looking for.
Now, Sarah, in response to the FTC penalty on Facebook, Alex Stamos, the former chief security officer at Facebook, had a pretty striking tweet. He said, "I can't believe Facebook didn't pay more for this. If the FTC offered to order Amazon to help consumers save money by offering house-branded options in every top category, Bezos would leap across the table with a $10 billion check and a massive grin." What does he mean by that?
He means that basically this is a valuable asset that Facebook is no longer allowed to share. Therefore, it's good for Facebook to have this rule in place. The Facebook of 5 or 7 years ago, the one that resulted in Cambridge Analytica, that's no longer how Facebook works today. There aren't developers making personality quizzes or games that operate on Facebook anymore. That used to be necessary in order to bring in more users. But in this current world, Facebook no longer wants that. And in fact, it wants to keep its entire network that it's built mostly for itself.
Now, it's interesting, Sarah, you just came out with a fascinating piece yesterday about how Facebook contractors are listening to audio of its users talking over Facebook Messenger, and yet, today the story about Facebook only getting stronger. Sally, I'm wondering, why don't these bad news stories seem to hurt Facebook more than they do?
I mean, I think the reason why the bad news stories don't hurt Facebook is because the enforcers aren't making Facebook change its business practices. So when it got the fine, and the fine was just a fraction of its annual revenue, and it was able to still keep doing what it's been doing, mining users' data in a way that they don't expect, and that's how it makes its billions of dollars. So that's why, that settlement was a win for Facebook. Until an enforcer makes them actually change their business practices in a way that affects profitability, their stocks are not going to be affected.
So, Charlotte, what is your expectation of how this FTC investigation, antitrust investigation of Facebook will play out, as well as a potential investigation into Amazon?
So, of course, it's hard to predict. We don't have access to the non-public documents that they are reviewing at the FTC. But I do think we should not expect that it's going to lead to huge changes. As Sally mentioned, the track record here is not strong on that. And antitrust is a actually very narrow and difficult area of the law. So actually, our hope is that there will be a new agency with new regulatory powers in addition to antitrust. And I think that's how we're really going to address the power that Facebook has.
All right, Charlotte Slayman of the Public Knowledge Policy Council, Sally Hubbard of the Open Markets Institute, and our very own Sarah Fryer. Thank you all. A story we're going to be covering for the next few years, apparently. Coming up, Tencent out with disappointing revenue growth. We will discuss how China's slowdown is weighing on the company next. This is Bloomberg. Tencent reported second quarter revenue Wednesday that missed analyst estimates, while the Chinese social media and gaming company beat profit expectations. Online ad revenue grew a worse than expected 16%. This as it grapples with increasing competition from rival ByteDance and a broader economic slowdown. Meantime, it was a busy quarter for the tech giant. Barely a week went by when Tencent wasn't making deals of some kind and tie-ups that involved everything from Super Mario to Lady Gaga. Bloomberg looks at its spending spree.
Back in April, Tencent struck a deal with Nintendo to revive stalling Switch sales and unleash the mini console on the mighty China market. Then in May, it was one of a few big Chinese names that pulled the right strings with the Hong Kong Monetary Authority to win a virtual banking license. Back home in Shenzhen, it was equally bullish, signing an agreement with the stock exchange to work on cloud computing research. And it kept out the fountain pen to sign an MOU with ZTE to build a lab for testing 5G tech on cloud gaming. In June, it teamed up with Singapore's investment giant Temasek to invest $35 million in a fintech startup in the UK. Last month, it went mobile in India to partner with Paytm and invest $100 million in a local streaming company. It also partnered with BMW to develop self-driving cars in China, and it said go, go, go to Pokemon. The two are developing new computer games to help Pikachu become Pika China. And Tencent hasn't slowed down this month either. It's currently tapping access to the back catalogues of Lady Gaga and Taylor Swift, negotiating terms for a 10% stake in the world's biggest record label. And if all that's not enough, sources also tell us it's planning to come back to the loan market with a bang, seeking to raise about $5 billion from banks. With so many fingers in so many pies, if the loan is approved, there'll be plenty of ways for Tencent to spend the money.
For more on Tencent, I want to bring in Bloomberg's Selena Wang, who joins us now from Beijing. So, Selena, what did investors focus on here? It seemed to be a mixed bag.
Yeah, Emily, even though those profit numbers beat expectations, the focus was really on that decline in growth around the online ad revenue. Now, even though this isn't the most important section of Tencent, it was a very promising area. We're really starting to see it get hit by some of these broader macroeconomic issues in China, as well as competition from the likes of ByteDance. What was interesting on the call was where the company pointed out the slowdown in advertising ad sales buying. So this is from the auto sector, the real estate sector, the financial sector, which is really not a surprise given the string of weak economic data that we've seen come out of China. Now, in terms of ByteDance, this is the big elephant in the room. That company has just been on a roll in terms of getting big companies to buy into their ads, as well as buying user eyeballs onto their platform. And the company didn't directly mention that company by name, but it did say that it would be investing more in mini video apps, short video apps, which ByteDance is a leader in, but it would also be beefing up its long-form quality content to try to differentiate itself from its competitors.
Now, gaming has been a controversial part of the business in China. Of course, the Chinese government has cracked down on the gaming industry. That has since eased up. But what did we learn about the gaming segment at Tencent today?
For Tencent, the worst is over in terms of the gaming sector, which is important given that this is still the company's most important revenue line. Now, we did see them start to monetize on some of their very important games, the new game including Peacemaker Elite. Now, for those who didn't know, this is the new, less toned down, less violent version of the very popular Battle Royale game that didn't get approval from Chinese regulators. Now, we didn't see the full growth from those game title monetization, but analysts are expecting that to pick up in the later part of the year. You mentioned censorship. For any company in China in the gaming, content, entertainment, media space, they have to deal with government censors, and those regulators haven't been approving these game titles fast enough. And we also heard from CEO Pony Ma that they're going to be focused on making less violent games. They're going to be trying to manage the time and keeping a more balanced profile of these games, especially when it comes to teenagers. And on that censorship front, the ad sales around media ad sales were also hurt significantly by censorship. And the expectation is that this is because of, as we're awaiting for China's big national day later in this year, they're slowing down and being more strict and cracking down in terms of what content can be shown.
Meantime, WeChat, of course, is the crown jewel of Tencent, sort of a super app to which there's no real equivalent here in the United States. How is WeChat doing?
In China, we certainly rely on WeChat for everything, whether it's communication or booking ride-hailing or haircuts, or pretty much you can do anything in it. And what's shocking is that this WeChat app is definitely reaching penetration, but it's still growing. It actually grew 7% to 1.1 billion users in this most recent quarter. Now, to try and continue to juice growth there, they're trying to add more services, more content into the app. They're also really focusing a lot of energy on these mini apps, which are essentially light apps within the app that encourages users to spend more time within WeChat rather than other parts of the internet. And we've seen companies respond really positively to those mini apps, and it can be used for anything from booking a car to ride hailing as well as bike sharing. So that's been a really successful area of growth within WeChat.
All right, Bloomberg's Selena Wang all over Tencent for us. Selena, thank you so much for that update. All right, shares of Pivotal Software are soaring in late U.S. trading Wednesday. This after a 13D filing showed that VMware and Pivotal are negotiating definitive agreements for a transaction to acquire all outstanding Class A Pivotal shares for $15 apiece in cash. Up until now, Pivotal shares had underperformed in 2019, falling nearly 50%. Still ahead, our conversation with Grab co-founders Anthony Tan and Huiling Tan on the ride-hailing company's ambitions to become a super app, plus how it plans to spend the big money it's raised from SoftBank. That's next. This is Bloomberg. As ride-hailing companies have battled it out for new turf around the globe, Grab has slowly but surely grown its own empire in the Southeast. Co-founders Anthony Tan and Huiling Tan have won over SoftBank's Masayoshi Son in Southeast Asia, defeated Uber in a turf war, and now want to become not just an app, but a super app modeled on Tencent's WeChat. I sat down with both Anthony and Huiling in our latest edition of Bloomberg Studio 1.0 and asked about the company's $14 billion valuation and how they intend to put their new money to work.
It's not just SoftBank. I mean, if you think about it, in fact, the first $3 billion wasn't raised by SoftBank. It was raised from Toyota to Hyundai to Booking to Microsoft, Ping An, Oppenheimer, right? You talk about we're very, very blessed with sort of the global best names one can imagine.
But why continue to raise money rather than going to the public markets?
Because of our super app ambitions, which now involves a much broader set of services for our customers, there needs to be additional innovation and additional investments. And those are the investments that our partners, they identify the opportunity and they're like, we understand, we want you to do it. In fact, they're encouraging us to go bigger, bolder, and better so that we can just serve Southeast Asia more consistently.
Tell me about your relationship with Masa. You've said that he's told you you can have unlimited capital from him. And yet I assume you're probably not asking for unlimited capital.
No, that means unlimited dilution. Masa and I are extremely close, and we're very blessed to have a mentor, a personal mentor, and a friend and partner in this journey. But I will not right now need that capital or want that capital today because we have enough capital to invest in what we need today.
So, Ling, you recently told me you surpassed $1 billion in revenue last year, that you're on track to double that this year. Where is the growth going to come from?
I think in terms of countries and regions within Southeast Asia, the biggest trajectory and growth area we've seen is Indonesia, and we're doubling and tripling down there as well.
How far away is profitability?
In certain markets and certain verticals, it's actually already profitable. Now, for us, it's really important that we build and create more value, right? It's very easy to say, hey, you're the most popular app, and then just be like, oh, chill, right? Or as opposed to, hey, we're the single most popular app, but there's lots of competitors, so we need to make sure we deliver more value so that we earn the right of customers to keeping us as the single most popular leading ride-hailing app.
Uber can't say when it will be profitable, and that has been a problem for investors. are you learning from that?
It's different. It's different. So first of all, Uber, majority of its business is ride-hailing today, plus obviously a food delivery. Lyft as well is ride-hailing. The point is, we see ourselves, our comparable is more WeChat, right, as a super app.
So will Grab go public?
Right now, we have no plans to go IPO. We don't need to go IPO, hence that very big round. For us, again, choosing long-term strategics, again, as part of our Tech for Good, working and co-nation building, is, when we talk about nation building, it's not 5 months. It's the next 5, 10, 15, 20 years.
Grab co-founders Anthony Tan and Huiling Tan there. You can check out the full episode on the Wednesday night edition of Bloomberg Studio 1.0, 9:30 p.m. Eastern Time, right here on Bloomberg Television. And that does it for this edition of Bloomberg Technology. We are live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network, TikTok, on Twitter. This is Bloomberg.